afternoon, everyone. Welcome to this afternoon's webinar about the biggest trends and challenges in fixed income trade automation for 2021. We are excited to have you all here for today's discussion. My name is Adam Anazi, and I'm a sales associate here at Overbond. I will be introducing our speakers in just a few moments, but first I'd like to go over some quick housekeeping notes. Please ensure that your mic is on mute throughout the entire webinar. We will open up the floor for questions at the end. Should you think of questions during the presentation, feel free to type them into the chat on the right-hand side, and we will answer them at the end. I will first begin by introducing Vuk Magdelinic, founder and CEO of Overbond. Before founding Overbond, Vuk's career spans over 15 years in capital markets and technology. As a PwC risk and regulatory consulting manager, Vuk led large digital transformation programs at both Deutsche Bank and BNY Mellon in New York City. Prior to PwC, Vuk worked at the CIBC fixed income trading floor in Toronto in structured products origination, where he modeled and priced exotic risk and structured fixed income investments for institutional, corporate, and retail investors. Our second speaker, Tim Self, worked as a macro rate strategist for a number of Canadian investment dealers, including CIBC World Markets, TD Securities, and Burns Fry Limited. Tim's background also includes fixed income portfolio management, trading, and derivative strategies from his time at Investors Group and Cornerstone Capital Partners. Tim is also a chartered financial analyst and holds a professional risk manager's designation. We will begin today's discussion with Tim interviewing Vuk on the key roadblocks for fixed income trade automation in 2021, followed by what the massive promise of AI in corporate bond trading is, then how bond issuers can access street quality data, and lastly, why smart order routing is the next frontier in fixed income trade automation. Vuk will then interview Tim on how the buy side can navigate a low yielding environment in 2021 to achieve superior risk-adjusted returns. Now, without further delay, I will hand off the mic to Vuk to begin today's discussion. Over to you, Vuk.
Thanks so much, Adam, and welcome everybody. As we come closer to the holiday season and reflect on 2020, what a year has it been? We are now obviously in December looking into 2021 and perhaps wondering how 2021 could look like. In our context at Overbond, with our clients, obviously we'll be discussing some of the trends as they are pertaining to fixed income trade automation. But as Adam has mentioned, in 5 key themes we've identified, more so focusing on data aggregation, AI applications, and what they mean for some of our key counterparties in the mix, sell side dealers, buy side, as well as issuers. So with that said, do please raise questions in chat. We'll try to address them. We've structured the discussion a bit of a Q&A format, perhaps like if you were to think of 2021 big themes in your head and asking questions to yourself. Tim will be asking me first some of the questions, and we'll see if the format is successful at the end, but do please raise questions in chat as we go along. And I'll pass it over to Tim and we can start.
Thanks, Vuk. Vuk, while automated bond market trading volumes in Europe, for example, are growing each year, are there any caveats you wish to share? And what challenges would there be in converting remaining voice trading to something more automated or digital?
Thank you, got it, Tim. Well, looking into 2021, I think needless to say, fixed income trading ecosystem will in some way stay OTC, over the counter. I think irony is, you see from a perspective of a data collector or an aggregator that I speak from, larger the trade, larger the ticket, or more important, the counterparty that's in that trade, it is more likely to execute purely OTC, so over the voice, or over the counter, as we've said. So that has a consequence that the data coming from that record is not as readily available as it would be if we've had purely electronic volume of trades coming down the API data pipe. So this means that even though we will see larger and larger penetration of electronic venue trade portion, and those volumes will certainly go up, and I think they have been going up in the last couple of years, and they're expected to go up in 2021. The market still has some ways to go to be fully electronic, and from that perspective, more integrated in terms of the underlying data. Now, in the interim, we're also seeing lower yielding environment that's here to stay, and market that still suffers from the anxiety due to COVID and other structural problems. So heightened volatility and illiquidity in some parts of the investment grade and predominantly in high yield bond trading market is to stay too.
Okay, Vuk, can you describe what is meant by client-side data aggregation?
Yeah, thank you for asking. And that's a kind of a coined term probably that we use more internally at Overbond than Street is perhaps used to. But it depicts a simple concept. If you look at an example, let's say a large buy-side client, connected on their bond trading execution desk to multiple venues, sourcing liquidity to anywhere 2-3 venues. They would need to somehow discern how to gauge what was, let's say, true liquidity per bond, per security, not just a modeled trade count, trade volume, and a view on one venue, but across the venues they're connected to. And obviously that's needed because any price tension, price discrepancies, would be aggregated then, and the level of analysis and insight would be deeper. And that doesn't exclude perhaps transcribing anything they get over chat or OTC traded via phone. So client-side data aggregation, coin term, something that we've realized obviously until industry gets to more of a fully electronically executed volumes and trade, is perhaps the only way for large firms to get a truer view and aggregate data that they have access to themselves. So data from venues they're connected to, data from composite feeds they source, data that is, let's say, transcribed from chats or voice, past records, and data that is in their OEMS systems. And then I wouldn't exclude post-trade regulatory feeds like in USD FINRA Trace, or even settlement layer data from some of the settlement agents that can give them a view on volumes executed in totality through those layers. Obviously, those come with different latencies. Some are near real time, some are 3 days late. But aggregating data overall across all of these sources is hard. Cleaning it is hard. Normalizing and deduplicating is hard. And client-side data aggregation kind of encompasses concepts of aggregating it from all the sources that a client, a firm, in this case, an example, buy-side firm, has access to, but then also, enabling that data to live in a data lake that then modeling layer can consume. And I'd say, from preparing data as something that I highlighted is really hard, I would maybe extend that it's even harder to do so in real time. And we know when it comes to trading automation, the real-time or near real-time processing is kind of the prerequisite. So that's what we mean when we say client-side data aggregation. And I think that is a trend for 2021 that could potentially solve some of these roadblocks we mentioned earlier. Hope that I addressed your question, Tim.
Thanks. So Vuk, how does AI as a fixed income tool help bond traders in their daily lives? And is the OTC nature of the market still a hindrance, and how long before this may be resolved?
Yeah, I think saying, there's a huge potential in AI applications in capital markets is kind of like, non-news. I don't think anybody's surprised. What we want to draw your attention to when we talk about the big theme for 2021 here is the AI applications in corporate bond trading specifically. And they're, drawing your attention back to that aggregation highlight that we just made earlier. Real-time data aggregation, client side, so across venues, across data sources, including all the historical record, as we mentioned, very hard to pull off. It is AI models that can do multiple benchmarking, comparison layers across numerous factors and market conditions, and learn from one state, let's call it market condition, to another. So it is really the AI modeling ensemble, or kind of a power ensemble, that is in particular impactful in context of corporate bond pricing, liquidity scoring, or what we call risk tiering. And from there, that can enable, RFQ automation, smart order routing, and all of these other applications that we consider, crux of the corporate bond trading automation. Now, until recently, we've had another sort of say showstopper here, and that is, most commercial AI models and applications could not run in their full scale due to the processing power or computational capacity limitations. So although, saying AI application in capital markets non-news, AI application in this particular, niche, which is corporate bond trading automation, and its relevance in 2021 is significant, and certainly so because of the two breakthroughs that are kind of being combined right now. And the first one is the application of serverless cloud, or the potential to get a model and kind of break it into 1,000 pieces and apply this heavy parallelization, which is almost the prerequisite to have that AI model with deep historical benchmarking, aggregating across, let's say, feeds in real time from 10 different sources of different type. That is a prerequisite to have it refresh within 3 seconds, or refresh within 1 second. So what we're talking about here as a theme for 2021, we're saying it's an application of serverless cloud architecture, heavy parallelization, and AI that delivers this promise for AI in corporate bond trading. I'll pause here, Tim. I don't know if there's a follow-up to this.
Yeah, Vuk, so what competitive advantages does Overbond and its real-time AI pricing engine offer from the standpoint of live streaming APIs and AWS?
Yeah, so the last word, AWS, there, right? It is Amazon, entity that delivers serverless cloud architecture. Obviously, there are others in the marketplace. AWS and Overbond have entered a partnership to engineer AI analytics that can apply this heavy parallelization. And the objective of this is to deliver, on one hand, speed, but on the other, precision. And obviously, for any trading product, trading analytics, automation product, both are prerequisites. So let me kind of talk a little bit about speed. So we have underlying any of these applications, really, live streaming API, data from different sources, different types, that needs to be aggregated, normalized, cleansed, mapped to the, call it a golden copy of a transaction master, real time. So let's say if we're focusing on a sub 3-second refresh rate in delivering live trading output, model will need to intake, aggregate, do the deep benchmarking across all of these similar issuers, entities, similar bonds, do the historical analysis, and optimize for pricing, liquidity, and retrain all within 3 seconds. So that wasn't possible without the application of here, in this case, for Overbond AWS serverless cloud technology. Now, on the precision front, we do have an ensemble of these AI algorithms, as I mentioned, that act in tandem, but that raises the bar in terms of how much computational power each one should consume. And obviously, that is another side that delivers precision, but it's equally computationally intensive. And serverless cloud technology in this case is also what we call elastic, meaning in a market that you might have, let's say, 2 ticks a second versus market that you have maybe 20 ticks a second. Coming down the pipe, obviously, the latter example would have more data to process. You would have this elastic capability to consume computational power. So you're basically kind of, in a simple terms, not breaking the bank. And that is, I think, the significance of Overbond partnership with AWS, or in general, AI applications combined with the serverless cloud architecture.
Okay. What challenges then do issuers face when monitoring their own credit spreads and issuing new bonds? And what efficiencies does full digitalization of the bond market address from the standpoint of corporate issuers?
Thank you for this question. Obviously, this is another big theme that we profiled, and the focus is now shifting a little bit to an issuer as a counterparty. And I think in the title here, under quotations, street quality data, the term data here could have been probably replaced with analytics. It's a street quality data analytics, or street quality insight we're targeting. And in general, when we think about the fragmentation of where bonds trade, where the data sources rely, and in general, how the view of what has traded, or what's that spread data coming from secondary market, and then also what is the view from the origination perspective when issuers want to issue a new bond from a primary market. It is a very fragmented universe, and it hasn't been necessarily easy for issuers to arrive at some semblance of consensus, or understand their credit price versus the peers versus what secondary market might indicate easily. So historically, most of the insight coming to the issuer was coming to the issuer from their respective debt capital markets coverage in syndicate of banks that would bring their bonds to market anyhow. But with the advent of some of these technologies and recent advancements, getting a quality report on an issuer side and getting the quality, let's call it street quality, data aggregated in a report that would have all the benchmarks and all the necessary components, so they can get a gauge and really start to, for the first time, to monitor capital markets, or debt capital markets, on their own account for the purpose of issuance, but also in general for purpose of benchmarking against closest peers, has become possible, easier to do. And from that perspective, we believe that more and more issuers would like now to get the insight of this type. Is it a weekly report? Is it a daily report? Is it a real-time report? Remains to be seen. But I think the theme and more adoption of this kind of tool on an issuer side is something we think will happen 2021 and onwards.
Okay, Vuk, can you describe the need for big data centralization in the fixed income space?
Thank you, Tim. I think you're perhaps asking here about data aggregation / centralization as it serves issuer insights. So in that regard, in many ways, need is similar to other use cases, with counterparties beyond issuers, like RFQ automation or pricing and liquidity scoring models on buy side or sell side. So more data, better data, more history, plus then AI modeling in speed and precision is needed to deliver quality insight, and that stands for the insight that issuers will consume. On the issuer use case, this means being, ability to now benchmark new issue spreads across dealer community that quotes them, their peers, seeing pricing tension through time in different tenors, or identifying opportune moments to issue in different currencies, monitor changes in investor preferences and demand across different target investor groups, and so forth. So if you look at all these dimensions, more insight, automated AI enhanced insight on an issuer side would also allow them to kind of open the logic up to different issuance flavors, or perhaps better timing. So I'll pause here. I hope I addressed your question.
Thanks, Vuk. So, Vuk, how is smart order routing the next frontier in fixed income trading automation? And can you also discuss how so-called SOR to different trading venues may have lagged, and how this should change soon?
Thank you. Yeah, so SOR, interesting. DAB is the next frontier. 2021 theme, perhaps 2021 to 2029 theme, if I was to kind of see it end to end. But in many ways, I think this concept of first things first applies here nicely. It would be great to automate trading workflow end to end right away, but that was just not possible in fixed income, given underlying data aggregation, fragmentation problems that were not solved. So with recent advances, that some of them we already addressed, such as real-time data aggregation, AI models in pricing, liquidity scoring, kind of risk analytics done per bond, per security, that enable auto RFQ layer, let's say, to a single venue. And I think that we've seen already in the industry being applied. The natural extension to that, further automation of the workflow is, to me, smart order routing. So smart order routing to multiple venues, because we obviously would want to see part of the traded volume on the desk automated, no touch, 100% end to end. And there is this last piece that's a decision-making process that is applied. Okay, well, I know the fair value or best executable price. I know which risk tier or per liquidity score the trade belongs to. I can even have kind of from my OEMS or in the venue already auto-populated RFQ response with that price. But is that the right venue for that particular trade, that particular counterparty at that particular time? That is what we're kind of talking about here with the SOR. And in many ways, it is a natural extension in a piece that's now sitting on all of these other pieces we've solved for. We see in 2021 as an opportunity here, a year where this use case could find strong product market fit. And with adoption of more and more SOR algos in fixed income over time, with, let's say, API-enabled data feeds that can be fed into any internal system or electronic trading venue, market can also benefit So the SOR algorithms could make it at large more efficient. So the marketplace at large could then see doubling or tripling of the trade execution response speed or overall trading volume. And I think that's quite exciting. Now, as I mentioned, is it 2021 or 2029? Well, I will maybe leave that judgment to the audience today.
Yeah, thanks, Vuk. I had a final question, but listening to your answer on the previous, you apparently have well covered it. So I think we can go on from now.
Yes, I didn't do that intentionally, but it happens. So maybe we switch the table, so to say, or I perhaps can ask you, Tim, about some of the applications or trends you see on the buy side 2021 agenda. So if I was to think about 2021, and a low yielding environment that's here to stay, and I know that you've been pondering and thinking about these kind of problems for a very long time, even prior to Overbond. How do you think one on the buy side achieves superior returns in this unprecedented low yielding environment we're all in?
Okay, thanks, Vuk. I think you have to start with the assumption that you're going to work around a core portfolio of corporate bonds. Now, the problem is that the Federal Reserve is going to hold short-term interest rates low for 2, 3, 4, 5 years even, while maintaining its quantitative easing QE bond purchase program commitment for that same period of time. We're going to have an environment of low all-in corporate bond yields and very low corporate spreads. And they're going to be, so with them being subdued for that period of time, the opportunities for yield and return enhancement are going to be quite low. As such, investors are going to need to go deeper into what we call the high yield space to generate some semblance of returns. Now, the problem, of course, is that the more you go into high yield space, you increase your risk profile. You've got their corporate bonds or high yield corporate bonds are riskier from both a probability of default standpoint and a liquidity perspective. So what you need is you need a helping hand, and that helping hand comes in the form of AI modeling. What you really want from the buy side perspective is you want to look to a way to employ the latest AI screening techniques to solve and screen for bonds that have that are best to buy and hold for a given risk profile, right? So you're looking at something you might not be able to do on your own, like through the old-fashioned way of just manually, but you need some AI modeling to help you look for things that enhance, roll down and carry, or some sort of metric evaluation, right? So that's the core strategy. Around that core strategy, I would personally also look to trade tactically against the rising rates. I think rates are going to go higher, but they might get out of hand and move at a rate faster than what I see. So, if rates move up, trade tactically with a long position, and I emphasize this is a short-term strategy around the overall strategy of incremental return enhancement around a core overweight position in corporate bonds. I could finish off with a quote from our CEO Vuk, and I quote: "Counterparties are increasingly adopting quantitative investing and liquidity risk monitoring techniques to automate their trading workflows and screen for securities that provide a superior risk-adjusted return in a low-yielding environment. This includes the consumption of increasing amounts of alternative data and using new methods of fixed income pricing analysis, such as AI analytics, like Overbond's probability default, similar security screening, and relative value pricing models.
Thanks, Tim, and thanks for quoting me.
Well, I thought you captured it.
I don't know, Adam, if we had any questions from the audience in the chat, but I think this would be a good moment to address any questions from the audience. And please don't be shy.
Vuk, I have a question for you. This is Jigger.
Hi, Jigger, please go ahead. Yes, we can hear you.
Thank you. Isn't my assumption correct that since the global financial crisis, dealer inventories of bonds is, they have less incentive to take inventory of bonds, so it's going more towards an agency-based trading model. How does is that true? If that's true, I'm assuming. I mean, what are your thoughts? Do you see it going completely agency at some point? And also, do dealers have an advantage in terms of data, especially the biggest dealers? If they're the ones trading all the bonds, they have more data than somebody who's trading on an agency basis or somebody who's buying data from external sources. Do you see that, or is that not an issue? Thank you.
Jigger, I would just ask you to repeat. It's been really hard to hear. There's a bit of an echo. I will mute myself to minimize the echo, though, and maybe we just can have a slight repeat. Sorry about that. I couldn't hear.
No worries. So the first part of the question was, is it true that since the global financial crisis, dealers are taking less and less inventory of bonds, especially corporate bonds, so they're trading more and more agency? And do you see that? And it's, that's, I'm assuming, works more to your advantage. Because it goes towards electronic trading more and more, or do you see dealers still taking inventory? And I think the second question was, do dealers have an advantage if dealers are trading the big blocks of bond trades? Do they still have an advantage because that data is not readily available to everybody out there?
Got it. Thank you. Yes. So on the first part, I think the trend you're highlighting, correct, right? I think that's very much the case. Dealers, having less capability to hold inventory, which as a consequence sees them, flattening their book, hedging immediately, not being able to buy, offload later, but maybe buy, settle, or flatten, hedge right away. And I think the consequence in our kind of predicament, which is providing them with solutions that can help, is providing them with solutions that can process data in speed, because actually the unit of time, the pressure on speed is higher now than it was, I think, 10 years ago in sell-side credit trading desk situation, at least. So that's where we have AI, serverless cloud, acting in tandem, delivering speed. As I mentioned, it's not speed at the expense of precision, it's both. Now, on the second part, which is, okay, I think you're saying, what is the limit to this, given, or what is a quality, realistic quality limit, given the fact that we are still in the OTC, or there is still a lot of volume over voice without readily available data feed to be given to these models to be, fast and precise. And there, this client-side data aggregation approach is what we identified as almost necessary step towards full workflow automation. So meaning if you want to automate your pricing, your liquidity scoring or risk tiering, plus your RFQ automation or RFQ responses, and then SOR on top, then some semblance of that OTC voice chat data that needs to be transcribed, normalized, and inputted is necessary, and there wouldn't be an external source that does that job for you. That will need to be done internally, and that's why we call it client side. So I'll pause here. Welcome any other questions.
Thank you.
Well, if there are no other questions, I do want to thank everybody joining today's webinar for your time and attention. We will have a recording, we will have some materials that can be distributed after, as well as shared on our social media channels and in general. So stay tuned for further conversation on these 5 topics. I want to thank Tim Self on his insight and help in preparing Overbond expose today for all of you. And also, I want to thank Adam Enosi for all of his help with logistics. Have a great day. Thank you.